This channel is for educational purposes only. Please do your own due diligence before making any investment decisions.
Hi, this is Joe Rabil. So what I'd like to do today is talk about some of the things that we discuss in our webinars that I have with my subscribers, as well as the Wednesday video. I get questions throughout the week, and people want to hear kind of my answers to those things. And we go over these important, I think, characteristics of being a successful trader. One of the things that I try and teach, and we talked about last webinar, was not micromanaging trades. All right. And I want to give you an example of a specific trade setup that showed up in my lists. It triggered. And if you were following the plan, you'd still be in the stock. You'd have a risk-free trade on. I'll explain that in a minute. And then also you have the potential for more upside. Even though you've already locked in some of the gains, your stop's at a break even, and then you can go from there. Now, micromanaging comes when we start over-focusing on all the price action and kind of skipping our trading plan. So I want to go through this in detail and make sure everyone understands it. Before I go into that, if you have an interest in learning more about some of these techniques, you can go to my website, rabilstockresearch.com, go to /book, and there's I'm offering a book right now at a discount, an ebook. All right, let's and also if you enjoy this content, please hit that like button and also subscribe. Okay, so the stock I want to talk about is Broadridge, BR. All right, and I've got all four of my time frames up. I've got a monthly, bottom left, weekly, bottom right, daily, upper right, and then an hourly. Now, this trade focuses on the monthly and the weekly. All right, we're not going to really look at this. I am going to talk about the daily a little bit when it comes to micromanaging, because that's typically where I see people getting taken out of trades that they shouldn't be taken out of. All right, let's go through this and explain what's taken place. So we've got a monthly chart showing a really nice pattern. Let's just zero in on this. It breaks out. It has kind of like a big cup and handle on the monthly, breaks out and then pauses. And I really like this pattern where we kind of form a new base on the base. So we've got this base here that formed on top of this base. You see how this is stair-stepping its way back up to the upside. So we get a move, we break out, and then we stair-step and what was resistance becomes support. And then we break out again. And then if you notice, what was resistance becomes support. Really good thing to be on the lookout for. Well, as this was pulling in and consolidating, it formed a pinch play with good momentum characteristics on the monthly. All right. So what I had started doing as this was pulling in was highlighting this right in this area. And what I would do with my reports is draw on a trend line and say, look, if we break this trend line, we have an entry. All right. And so let me zero in on the weekly chart because this is their trigger time frame. Monthly is the trend time frame telling us we have some potential significant upside. And then the weekly is telling us when to do it. All right. Now, if you notice what's taken place, we had a pinch play on the monthly, and look at the way this developed. Nice and orderly consolidation, two moving averages coming together, and then the MACD comes down towards the zero line, and we have a very low ADX. Now, the other thing that did take place is we have a significant reverse divergence taking place. So we have one from a bigger picture standpoint, and then we also have one here where it happened in a shorter term time frame, just in the last leg. All right. So as this is developing here, we're watching for this trigger. Now, because now this is right out of my course, because MACD is above the zero line and the ADX is low, so we have no overrun and no real selling strength, we can buy the trend line break. So I've already drawn the arrow in. It shows, and I just used the close. You could have gotten in a little early, but let's just use the close. It's 205.45 is the entry. Now, the stop is using an average true range. 2 times the average true range would be 1450. All right, so we're giving it some room. We want to let it breathe a little bit. When we have a monthly, weekly trade, we want to make sure we give it the opportunity to trend. All right. So we've got our stop in. So that's what this is down here. One thing I really do like is when I enter here, I do like it to be below the last swing low if I can do that. All right. I definitely want it to be below the 18 week at a minimum, but preferably if I can have the stop below the last swing low, it really improves my chances of not getting stopped out on nonsense, on noise. All right. So we've got that. I've got my stop down here. Might look like I'm giving it a lot of room. Not a problem. All right. This is the one major thing that really changed my trading was using wider stops. All right. Now, the plan is I'm going to put this trade, I've got the trade on, I've got the stop in, and what I'm going to do from here is I'm going to take a quarter at 1R. All right. 1R is 14.50. I 1 unit of risk. That's from my entry to my stop is $14.50. So I'm going to add 14.50 and I'm going to take a quarter off when I hit that, which I did up in here. All right. So that's 1R. All right. So I take a quarter. So if I bought 400 shares and I sell 100. Now you're not getting rich off this first quarter. All right. What this first quarter does for you is it reduces the risk of the position. So now you only have 300 shares. Okay. You've taken a profit on that 100 shares. But more importantly, what you do is you raise the stop from 14.50, you cut it in half, and I've already drawn in this little line here. This is 7.25. So this is the average true range for the stock when we bought it. So I'm cutting the risk in half. So now on the 300 shares, I'm only risking $7.25 instead of the 14.50. So what's left, I'm only risking half of what I started. Now, when we look at this, let's say your original risk is $500. All right, in a trade. Like you put on a trade and you risk $500. Now that might not apply here, but let's just say that's your risk parameter. You have a $50,000 account and you're going to risk 1%. That's $500. All right. Now, if you do it that way, if you do it the way I'm suggesting, after you hit that first target, you've taken a small profit and you've raised the stop up. Now you might be risking $50. Instead of risking $500, you're now risking $50. Now all of a sudden, this trade is a pretty low risk trade. I mean, yeah, you could get stopped out on the 300, lose some money on that, but you've taken a small profit, and in the end, you lose a little bit. I mean, I might be a little off. Maybe you lose 100, 75, or something like that. The bottom line is you're taking most of the risk out of the trade. All right. So once you've done that and you've raised your stop, now you have to be disciplined to follow your plan, because your plan says at 2R, we're going to take another quarter. No, actually, that's wrong. On a long-term trade, on a monthly, weekly, all we're going to do when we hit this next target is raise the stop to a break even. All right. So now I'm going to move this and my entry point is here. So now all of a sudden my stop is going to go, once I hit that level, this next target, my stop's going to go here. Now, the question becomes, if you're watching this and you're seeing what's going on here, you're seeing this pull back. Notice how this came down and it broke the 18 and then it closed below the 18 and then it took out the low of that. All right. Now, the stop would have been way back here, giving it a lot of room. But I notice what guys do is they're watching the trade and they see this break and they're like, you know what? I'm going to take a little profit here. I don't want to take a loss. I don't want to, I don't even want to go to a break. I don't even want to take a break even. I just want to get out of this trade and I'll take a small profit. All right. And I know that because I did stuff like this in the past. And what I'm telling you is that you have to follow your plan. You can't micromanage. Now, I mentioned looking at the daily chart. If you're looking at the daily chart and you are seeing this price action, okay, and you're watching this every single day, the likelihood is it's going to scare you out, especially when you get a little gap down or something like that. At some point in here, if you're watching it and you're trading monthly, weekly, and yet you're looking at it every single day, the likelihood of you micromanaging the trade and stopping yourself out, pulling the stop and just getting out of the trade is probably pretty high. So avoid doing that. If you're trading off the monthly and the weekly, avoid looking at the daily, at least during the day. All right. Don't even worry about looking at it. Look at the weekly chart and the monthly chart during the day if you want to look at what's going on, but don't look at the daily or don't really get too focused on it, because if you do, it's really going to increase the likelihood that you scare yourself out of the trade. You think it's breaking down. You think there's a problem. The daily chart breaks down all the time. There's a lot of volatility there. All right. So we're going to follow our plan and not micromanage. We're not going to watch the price action that closely because we're going to believe in our plan. So the idea behind this is we're going to enter. Okay, we're going to have our stop down here. We're going to try and get that first target, and if we do, we can lower the stop, raise the stop to the point where we're risking a lot less on the original entry. All right. So if you can get to that point, now you've taken a lot of the risk out of the trade. Now, if you live through this consolidation and you get to this point here, now your stop is at a break even. You still have the 300 shares that you started with in this example. All right. And I'm at a break even on the balance. This is where you need to be as a trader. If you can get trades to a break even, all right, you're going to, so if you get, especially if you've taken a small profit, you've got a break even in place, you can now rest easy. I find I'm really a phenomenal trader from here. From this point on, once I hit that target that gets me to a break even, I know, and I'm done it the right way. I'm not just going up when this comes up here and just going to a break even immediately. I'm following my plan. And my plan says when I hit to this, I'm going to raise this to a break even, and I'm going to go from there. Notice how it works. It's using the stock's own volatility. So it's not surprising that when this target was hit, this stop goes right underneath this last low. You see how that works? It's the stock's own volatility. It's going to go ebb and flow based on its own volatility. So it's not that surprising. So in this case, we have a trade where we've taken one profit. We're at a break even on the balance. We still own 75% of what we started with. And I have the potential to go hit some targets and keep trailing a stop from here. Now, more and more of the details come with the course of how to handle it from here. But the point I'm making is that you can't sit back. If you're playing on these longer term trades, especially, you can't sit back and watch every single pullback, every bad bar, every time we get a reversal. If you do that on the daily chart, the likelihood is you will not see this trade through. So I thought this was a good example just to sort of explain how you get from here to here and understanding how to reduce the mental stress and anxiety. Now, what you want to do is follow this plan for 20 to 25 trades and evaluate how it does. Go back and look at your old trades and see if this plan is working for you. If it's not, then you can tweak it. But don't do it inter-trade. Don't do it while the trade is on. Say, oh, I don't like the way this is working. I'm going to change my stop or whatever. Follow your plan. Follow your plan for 20 to 25 trades. And then after you're done, look back and see what it tells you. So this is the approach that I use. It'd be the approach that I recommend to my subscribers. This is what I recommend for you. All right. Let me know if you have any questions. Thanks.